Selling naked puts is how I get paid to buy great companies at a discount. I've done it for over a decade. It's a core part of my verified $2.8 million portfolio. But there's one version of a naked put I refuse to hold: the long-dated naked put. This one rule is a big reason why market crashes do not scare me. Today, you're going to learn why long-dated naked puts are dangerous, the simple rule I use instead, and a real trade where following this rule paid me money just to reduce and remove the risk. My job is simple: win when you're right, win when you're wrong, never gamble. And stay till the very end. I'll show you the exact role I'm planning right now. The rule in 6 words: short the risk, long the reward. My naked puts stay short dated, my upside stays long dated, never the reverse. If you're relatively new to options, let me explain naked puts in 20 seconds. Selling a put equals buy it on sale order below today's price, except you get paid cash today just to place the order. Naked means there's no lower put protecting you. The obligation is yours alone. How do you know that you're doing it right? You only sell options at strike prices that you would love to take ownership. And by doing that, you have a powerful edge. The edge isn't in the put itself. The edge is in the discipline around it. Why long-dated naked puts look so attractive? A put expiring a year out pays a big upfront premium. It feels like free money. One trade, one commission, set it and forget it. The strike looks impossibly far away right now. In fact, I've seen other YouTubers brag about how much premium they've collected, not realizing that that premium creates a substantial obligation in the future. That big premium is not a gift. It's the market paying you to carry a year of danger. Quick story: March 2026. The market dropped about 7 or 8% in a hurry. Fear spiked. Option prices exploded. Traders holding long-dated naked puts watched those put options balloon against their account. With months and months left on the clock and no cheap way out, oftentimes those traders were forced into a margin call and they had to liquidate their positions at the worst time possible, only to then see those same positions quickly rebound. The problem is they were forced to close out those trades because they had a margin call. We were down less than 1% during that exact same stretch. Not because I predicted the drop. I didn't. The reason is that my risk was short dated. Time was on my side, not the market side. Here's exactly why long-dated naked puts get so dangerous in a moment like that. What a crash does to a long-dated naked put: fear inflates it. When fear spikes, all options get more expensive, especially on the put side. And the longer dated the option, the more a fear spike inflates it. Your buyback price explodes. So you can sell an option for $1 and then be forced to buy it back for $20. A far out expirations means months of earnings, Fed meetings, and headlines. Months of ways for things to get worse before that position expires. The buying power backing that put is locked up for a year, right when opportunities are cheapest. And during really volatile times, your broker will frequently increase the margin requirements on positions. So it makes it even worse. You're left without buying power at the worst time possible, which is one of the major reasons why so many people who sell options end up blowing up their accounts. Time is the risk. A short-dated put carries weeks of risk. A long-dated put carries a year of ways to go wrong. Same strike, same company, very different danger. And also, a long-dated put is much more sensitive to changes in volatility than a short-dated put. So what do I do when a naked put I hold is too far out? I roll it in, and I get paid to do it. Let me show you this rule in action. A real follow-up trade I sent my members a few weeks ago on Micron. The original trade had a naked put expiring in November, too far out for my comfort. So we made the move most people never make on a winning trade. We further reduced the risk. And also, we got paid to do this. Here's the exact trade. We were paid $77 to remove months of risk. You can see that I wasn't comfortable with the November expiration, so I rolled it into August, and in order to pay for that, I increased the strike price from $370 to $510. I bought to close the November $370 put, In exchange, I was paid $77 and I made this trade substantially safer because let's say over the next few weeks the Micron falls to about 650 or 600. If that strike price ever gets challenged, all I have to do is just roll it out in time and decrease the expiration again. So it's really not a big deal. I'm decreasing risk and I'm getting paid to do it. What that one roll changed. Before, the naked put was all the way out in November. I had months more crash exposure. And remember, I also had capital tied up for a much longer period of time. After the roll, the risk window ends in August. Once it expires, I only have upside because my original trade was a call debit spread financed by a naked put. So once that naked put expires, I only have the call debit spread left, which is pure upside. Plus, I received a $77 credit. And when I put on the original trade with the November expiration, I also received a credit. Less time at risk, more money collected, and less overall risk. Here we open up an SMH trade. The reward is the call debit spread, the 700 by 900 that expires in December 2028. This gives me $20,000 of upside held as long as possible. I financed it by selling short-dated naked puts that expire in December 2027. Therefore, my risk is held for a shorter period of time while I'm giving my long call debit spread a longer time to be right. Short the risk, long the reward. Same rule every trade. Quick, don't go anywhere. In about 90 seconds, I'll show you the exact roll I'm planning on my own SMH position right now. The legs, the strike prices, the timing, the expiration, and why I expect to get paid to make my trade safer. But first, how a roll actually works and the one mistake that ruins it. How rolling a put in works. 3 steps. You buy to close the far dated put. Therefore, you're out of the long risk window. Then you sell a nearer dated put, a shorter clock, often at a strike you like even better. You strive to collect a net credit. Done right, the market pays you to reduce your own risk. Let's say you're thinking, but long dated puts pay more premium. That's true. And that extra premium is your payment for carrying tail risk through every earnings report, Fed meeting, and crash window for an entire year or more. Option time value decays faster near expiration. So per month of risk, short-dated puts usually pay you substantially more on a theta decay basis. Selling a shorter put several times collects premium again and again, while never carrying a year of danger at once. You're not paid more for longer dated puts. You're paid for holding the danger longer. And remember, when you sell long dated puts, you're not going to be able to put on new trades because your buying power is going to be tied up in that position. The number one mistake and the structural fix. The mistake, holding a long-dated naked put into a fear spike, then panicking and buying it to close at the worst possible time, or getting forced into a margin call and being forced to close out the trade. The fix is actually the structure. Never be in that position in the first place. Keep naked puts short-dated at strikes you'd love to own, and time bails you out instead of burying you. Discipline beats bravery. Structure beats prediction. Does this discipline actually show up in results? Let me show you the account. Around $2.8 million of verified portfolio on E-Trade. You can see the returns in March 2026 when the market was down around 7 or 8%. And when everyone was very scared and volatility was spiking up, my account was down less than 1%. Short the risk, long the reward. The real lesson, naked puts are a tool. Long dated naked puts are a trap dressed as a paycheck. And also think about it. If you're selling long dated naked puts on great companies, the amount of premium that you collect is probably going to be substantially less than the capital gains that you would have received had you just been long the stock. So all these people that are telling you that it's totally cool to sell puts that have long dated expirations because you're going to collect as much premium as possible, the reality is that had you simply bought the stock at the current market price, you probably would have ended up making substantially more money in capital gains than the premium you collected from selling the naked puts. That's why you need to keep the risk short dated and you need to keep the reward long dated. The call debit spread that we put on mimics the long stock, but it's just much more capital efficient. That way you can use leverage without getting hurt if the market crashes, because leverage, when used incorrectly, is very punitive. But the way that we trade, we mitigate that risk. And when a put sits too far out, roll it in. And you can get paid to make your trade even safer. Win when you're right, win when you're wrong, never gamble. All right, here's what I promised you. The exact roll I'm planning right now on my own SMH position. The same rule you just saw that worked on Micron applied to a live trade in my account. My planned SMH roll. Currently, I'm short the December 2027 490 naked put. In my opinion, this is too far out for my comfort. My plan is to buy it to close and sell a nearer dated put that expires in December 2026. And I'm going to execute this soon, similar to the Micron trade. And I'm going to collect a net credit for the roll. By doing this, I'm going to get paid to shrink a full year off my risk window, while the December 2028 call spreads keep all of the $20,000 upside. The way that I'm going to do this is different than the Micron trade though, because with Micron, the put strike was so far out of the money. With SMH, the put strike is not that far out of the money. So I'm going to keep the 490 strike or even decrease it slightly to about 470. And the way that I'm going to reduce the expiration is I'll buy back the 490. I'll sell the December 2026 490 or the 470, and then I'll finance that by selling SMH puts that expire within the next 2 or 3 weeks. So I can sell 3 or 4 SMH puts that expire within the next 2 or 3 weeks that have strike prices of about $520. Then I'll use that premium and apply it to the original 490 put that expires in December 2027, and therefore I'll be able to reduce that position by an entire year. Now remember, if you're going to sell some additional short-dated naked puts to finance the roll in, you never want to be in a position where you're selling so many of them, where if SMH ends up trading below 500, that you would be forced into a margin call and you wouldn't have the buying power to take ownership of those shares. So you have to be disciplined in how you deploy this as well. So that's the rule I never break. Short the risk, long the reward. It's kept me calm through many of the recent pullbacks that we've experienced in the market. Who's telling you this? I'm a former Wall Street investment banker. I've worked at Morgan Stanley, CIBC, and Petsky Prunier. I'm an Ivy League graduate with 10 plus years of experience trading options. Do you want every single trade I send my members in real time? The 14-day trial link is in the description. If naked puts still make you nervous, watch this next video, The Hidden Trap in Selling Puts. I'll put a card right here, and tell me in the comments which of your favorite companies should I break down next. Win when you're right, win when you're wrong, never gamble. See you in the next one.